which brings us one step closer to the money management rules that determine your optimal trade size. So, important, a lot of traders trade with way too much lack of discipline when they trade. So, for instance, they could be trading a lot of different assets at the same time. They trade at very different times throughout the day. They use a whole bunch of indicators, different time frames in the charts. And then, of course, when you have all these many moving parts, it's very, very difficult to get to a point where you can converge on an optimal trade size, because you really don't have one strategy. You have 15, which is about the same thing as saying that you don't have anything, because you can't do everything at once and do it well. So the important message is, do not try to figure out your optimal trade size until you have figured out what your trading strategy is. So, and for instance, a trading strategy could be the best or the simplest would be, I trade for about between 4 and 8 hours in the 12-hour time frame in the euro dollar and Canadian dollar, and I have a stop loss at plus 25 pips and a take profit at plus 50. And I trade with a leverage of, say, 4 to 1, because that's what I try to do. And that's something that you could do. If you trade in, you play some trades for 5 minutes and some trades for 5 days in completely different asset classes and so on and so forth, then there's just no way. You're not ready to try to find your optimal trade size, because you don't have a strategy yet. Okay, so with that caveat in mind, let's get going. And explain why it's just so important to focus on different time frames. For instance, what I've got here is a plot of the daily volatilities for different pairs at different times of the day. And as you can see, let's focus on the euro dollar. So the euro dollar is a lot of different assets at different points in the day. So beyond it really depends on the Asian session. Not much volatility because nothing much is going on. So there's a question here on what I said, what the stops should be. I just made up the numbers. So those numbers are completely and possibly unrealistic. I just made them up. The point is you have to figure that for yourself, and I'll show you today how to do that as we go along in the webinar. The point is, though, that no one should tell you what your take profit should be. It's you who has to figure out for yourself, given your trading style and your trading strategy. Okay, so the point I was making is be careful as you try to figure out your strategy when you pick at what times of the day you trade, because the volatilities of the market are wildly different. So, for instance, at this point in time, the volatility could be about 10 times the volatility if you trade about 10 hours earlier. So you should factor that into your strategy formulation process. And then, of course, even more important is just very simple things like be wary of news releases. This is the volatility of the market in the euro dollar, slightly before and after a non-farm payroll. And as you can see here, the volatility spikes at the moment when the news are released, and it continues to be quite high even for more than 1 hour later. So that you have to figure out. If you're someone who trades the news, your optimal trade size should be X. If you're not trading the news, then you can afford to take a lot more leverage, because there will not be such mild spikes in the market. Why is this important and why is this helpful? Well, if you really focus down to the bits that allow you to be concentrated and get to a point where you're seeing if your strategy works or not, this will reduce your anxiety. It will allow you to see whether you're doing well or not doing well on your strategy. And once you see what's not working about the strategy, you can start optimizing, including the optimal trade size. And then when you come to formulating your optimal trade size, and I'll show you later how to do this, but the important thing to take into account is that different strategies have different optimal trade sizes. So for instance, let me show you, let's think of a strategy which places 1 trade per day or 21 trades a month, trades with a leverage of 10 to 1 for each of those trades, and hangs on to those trades for 1 day. Well, that strategy in the worst month every 20 could lose about 40% of its capital. If we talk about another strategy which places about 2.5 times the number of trades and trades with twice the leverage, but doesn't stay in the market for so long, instead of 1 day, it stays for 4 hours, that's a comparable way to get to the same value at risk with completely different strategies. This one trades a lot more often in shorter time frames and still is as risky as the one above. By taking twice the leverage than this one. So the optimal trade size for this strategy and that strategy would be different, even though ultimately they would end up with around about the same value at risk on a monthly basis. Or you could even take it further. If you just trade in the hourly time frames, you could afford to take up to, say, 100 trades a month with a leverage of 30-81 and still have the same risk as the strategy above. What's the point I'm trying to make here? Well, the risk of your trades is linear in the number of trades. So if you take double the amount of trades in a given month and the trades are the same, then you'll take pretty much double the risk. And it scales by the square root of time. So if you're taking a trade for 4 hours, then the risk of a trade for 24 hours, which is about 6 times longer, will be roughly the square root of 24 over 4, which is the square root of 6, which would be 2.5 times. So if you take the trade for 24 hours with the same leverage as a trade of 4 hours, then you're taking 2.5 times the risk. And that's something you need to figure out when you're defining your optimal position size. Now, you're probably saying, okay, this is all very nice. So how about some practical examples here? Well, before we get into that, I'd just like to show you what the differences can be by trading a strategy with one amount of risk and another amount of risk. On the left-hand side of the slide, we've got a strategy which is trading with a lot of value at risk. It's taking way too much leverage in each of the trades. And as you can see here, the returns in April and May and June essentially blew up the account and it's lost 100% of what it did have. Now, if instead of taking that strategy and applying the wrong trade size to it, you had taken something more rational, you could see that there are a whole bunch of retail traders out there who have winning strategies and managed to destroy those by taking way too much leverage on a trade basis.